It was a seminal moment. I think it's fair to say. October 24th of 2022, you send the letter to Facebook, quote, time to get fit. The stock is up 267% since your letter. Incredible. What was most impressive to you here about this particular quarter, Brad?
Well, first, let me just say, as I've said many times, you know, all credit goes to Mark and Susan and the incredible team at Meta. But what we saw this quarter is the same reason we bought the stock and wrote the letter, which is it's in the numbers. Revenue was up 25%. Stephanie just talked about engagement being up on video, 25%, driven by AI. But even more impressively, free cash flow was up 28% because of their commitment to efficiency. Right? When we wrote that letter in Q3 of 22, the headcount at this company was 87,000 people. As of this quarter, it was 67,000 people. They've nearly tripled their earnings per person working at the company in over that 15-month period of time. And now the world is starting to see what we've discussed many times over the course of the last year. You know, a year ago, everybody said that Google was king of the hill when it comes to AI, perfectly positioned for AI, and that Meta was nowhere in the game. But remember in the letter, one of the things that was probably most undercovered was I said, control the cost and investment in AR, VR, and double down on AI. Right? That was a couple months before ChatGPT hit. And oh, have they doubled down on AI? They are the single largest beneficiary of AI from a profit perspective in the public markets today outside of NVIDIA. And so I really think it's about that. And when I look forward at the stock, I expect it to continue to work because I expect the numbers to continue to be delivered.
You know, it's so interesting. When you wrote the initial letter, he kind of gave you the Heisman for a moment, then reported earnings, didn't pay any attention to what you were suggesting. Last night on the earnings call, he, being Mark Zuckerberg, of course, said, I really think we operate better as a leaner company. Did you ever think you would hear Mark Zuckerberg say those words?
I did, actually, right? You know, I got a lot of grief, as you know. We wrote the letter on a Monday. They reported earnings on a Thursday. And I got a lot of grief, people saying, you know, why would you do this? Mark has supermajority voting control. But I did it precisely because he's the type of leader with founder authority. I knew how much he cared about this company and that he could redirect the ship. You know, many companies get so large that you can't turn the ship easily. But Mark was able to turn the ship, you know, and when he wrote the letter, Year of Efficiency, in February of 23, right, where he said flatter is faster, leaner is better. It was the call to all of Silicon Valley, to all of technology, right, to get fit. And they led the charge. I think he deserves a tremendous amount of credit for that. You know, and like I said, they've tripled their earnings per employee while going from 87,000 to 67,000 employees. You know, if you look at Google over that same period of time, I pulled the numbers this morning. They have 187,000 employees in the third quarter of 22, and they still have 183,000 employees, right? They barely moved the needle on their earnings per employee over that period of time. So, you know, it's not that this got easy for all tech companies, right? Execution matters. This is a founder at the top of his game who's doubling down on AI and who's going to lead the next super cycle rather than get left behind by it.
I thought that Deirdre Bosa, just before we came on the air, just made a wonderful point that the proof of what this company and Amazon and the like is that they can innovate and return cash to shareholders and at the same time still get more efficient. You just wanted their spending to be more targeted toward what I guess you saw where the puck was going, rather than on some moonshot, which may pay off, may not, but it wasn't going to be the big needle mover for the future.
You know, I mean, if you think about it, they're going to spend $20 billion this year on Reality Labs. Just to put that in perspective, the market is assigning, that's $6 in earnings. The market's assigning a 20 times multiple to the company. So that's effectively an implied valuation of negative $120 per share for Reality Labs. Now, I happen to think that, as Mark said on the call yesterday, there's an emerging synergy between the work that they've done in Reality Labs and what's going on in AI. Look at what happened with the Meta AI glasses. Look at how they're leveraging their infrastructure, almost 600,000 H100 equivalents. Look at how they're leveraging that into an open source model that will bring us open source AGI and Llama 3. So I actually think the investment that they've been making in AR/VR today is a lot more valuable than I thought it would be a year and a half ago. But that was before ChatGPT. And so we see that, that value growing. But they also, and credit goes to Susan Li, they're taking this balanced approach between returning cash to shareholders by way of buybacks and dividends, at the same time making extraordinary investments in the business. Just $20 billion in just Reality Labs alone. I think that negative $120 billion or $120 a share in attribution to Reality Labs will end up being a positive enterprise value. In much the same way we gave negative value to AWS when Amazon was incubating it, some 15 years ago. But the truth is, it turned out they were digging the largest gold mine in the history of corporate America in plain sight, while Wall Street was attributing negative value to it.
Let me ask you this. I do have another question related to Meta's, earnings and that. But the week that was, what did we learn this week about the hyperscalers relative to AI? It's seemingly starting to distance themselves from each other rather than trading in a pack. Is that the lesson of the week? It obviously speaks to what Microsoft did and what, in some respects, Alphabet didn't do. And now Meta on top of that. Amazon has its own AI dreams and hopes, and through Anthropic, and then the announcement they made with Rufus yesterday. But what did we learn this week?
Well, I mean, Scott, we've been talking about this over the course of the last year. When it comes to the hyperscalers, cloud infrastructure, AI infrastructure, I think what we learned is that the year of belt tightening from 2023 is over. Organic growth rates have returned to where they were before that belt tightening occurred, and we're seeing the inflection of these new AI workloads, right, which are just beginning. But I was looking this morning, in the quarter, if you aggregate the hyperscalers together, we added over $15 billion in ARR. That's annual recurring revenue, the single largest quarter in the history when you look at that aggregated number, right? And that is both a combination of the organic growth in data and infrastructure that's being built, which will benefit other companies like Snowflake, and also these new AI workloads beginning to kick in. But we also saw, in the case of Google, as I've said, it's the greatest monopoly with the greatest monopoly profits in the history of capitalism. But replicating those monopoly profits in the age of perplexity, in the age of AI, in the age of answers, where everybody's gunning, right, for a piece of that profit pool is going to be very difficult. And so, I think we saw that again. Look at it today. Meta's up 21%. I think that Google's actually down on the day. And it's not to beat up on Google, but it is to say that they haven't really made any change from 187,000 employees to 183, and they're going to be attacked from all fronts on their core business by other people who have designs on AI. So for me, that's one of the big takeaways. The winners, Microsoft, Amazon, and I think some companies we're going to see report in the future who are taking advantage of selling those services and AI infrastructure stacks. And on the other side, the tip of the spear, when it comes to the applications and driving AI profits, you certainly have Meta. And while it's not public, ByteDance, TikTok, where we're also investors. Now, while I know controversial, certainly in some quarters, is an extraordinary business with extraordinary growth rates and extraordinary incremental profitability that looks a lot like Meta. And I believe deserves to come public and will come public over the course of the next couple of years.